Good morning, everybody, and welcome to our live roundtable discussion with, I'm Jack Sheehan. I'll be the moderator for today. Today's discussion is around international tax developments in Asia, and I'm joined by colleagues from the OECD, Loyens Loeff and IBFD. In terms of some housekeeping rules, is that we will have a Q&A at the end of this session. It's any questions that you have during the session. There is a function you will see on should be on the top right hand corner, and there's a bubble with a question mark in it, and you can post your questions in there, and we will deal with them during the Q&A session. So moving on to our agenda for today. The session will be broken into essentially 4 parts. The first part will be discussing the recent international tax developments in Asia, and we will be discussing that with Matt from the OECD and Rachel from IBFD, and then we will have a discussion around international tax structures in the region with Barbara from Loyens Loeff, where we'll be specifically discussing the MLI, the multilateral instrument, and some implications around the principal purpose test and what that means for tax structures in the region. And then finally, we will have a discussion around the tax policy and what's coming out from the OECD with Matt around the BEPS Pillar 1 and 2, and then we will wrap up with to try and answer any questions you may have this morning. So a quick introduction to our speakers today. Firstly, Matt Andrews. Matt is the head of tax treaties, transfer pricing and financial transactions at the OECD. Matt is also leading the development of the tax policy of the BEPS Pillar 1 discussions, which we will talk about later. Prior to joining the OECD, Matt was an international tax partner at a Big Four firm, where he was a Big Four partner in the US, Australia, Singapore, New Zealand over the last 20 years or so. We're also joined by Barbara Voskamp. Barbara is a partner at Loyens Loeff, a leading European legal and tax firm, and Barbara leads the Singapore office. I think Barbara is quite well known international tax advisor in Asia for her contributions from both an Asian and a European perspective. And lastly, we're joined also Rachel Shaw. Rachel is the head of Asia Pacific for IBFD. If you're not familiar with IBFD, IBFD is the leading international tax body for publications, research and education on all things international tax. And Rachel has extensive experience advising on cross-border tax issues, particularly from a tax administration and a tax policy perspective. So I'm delighted to welcome our guest speakers today for this very special roundtable discussion. So I think we will move into the discussion because we've got quite a bit to discuss. So Matt, Rachel, Barbara, well, welcome first of all. And I think if we look at where we are today, we have not left this pandemic just yet. I think in the future we will remember the years 2020 and 2021 as marked by, you know, the travel restrictions and COVID and the pandemic and all of that. But as we can see the light at the end of the tunnel, and you know, in terms of where we are in the region with international tax and recent developments. So what are the kind of key issues that you see from an international tax perspective as we're moving out of COVID? Maybe I'll ask Matt first. So Matt Andrews, what do you think?
Yeah, thanks very much, Jack, and thanks for the opportunity to be on the panel, and I wish everyone a good morning / afternoon wherever you are. Look, I mean, the area that I'll cover, Jack, is in relation to the recent guidance provided from the OECD in relation to transfer pricing, and that was released in December 2020, and it was really guidance which was produced at the request of business, but also member states as well, and not the OECD, but the inclusive framework, which includes 139 countries. And I think it's important, Jack, for this particular discussion, because obviously many countries in Asia are not OECD countries, but actually are inclusive framework countries. And so we provided some advice, which was a frequently asked question type of document and when we went out to business and members who had lots of questions and lots of concerns, well, what do I do with my transfer pricing? I've got losses. What does it mean for my characterization? Does it mean I have to document this year? What do I do with my losses? I've got extra costs. I've got government support. What do I do? Does it change the way that I'm going to do my transfer pricing documentation and the way that I transfer pricing for 2020 and 21, 22? And the answer is, in true consulting fashion, it might. And so what the document sort of came to was 4 particular points and outlined 4 key areas for business and for governments to give consideration to. The first of that is the treatment of government support, such as government subsidies, government-backed loans, and furlough schemes. And it was an area we focused on because a lot of governments and also business were like, well, hang on, I've just been given $1 million from a government in France, and I want to use that to pay and support some of my subsidiary companies in Asia. Or I've got government support from the Singapore government. Can I pass that on to my subsidiary, 100% owned subsidiary companies? And so that was a key issue because that changes potentially the risk profile of the Singapore company in that case, and also the subsidiary companies as well. It could also change the characterization and even the way that the transaction, the economic risk with the transaction. And so we've provided some advice in relation to that, which is this, it's an important point because it changes the economic relationship between the companies. And so that's the first point. The second point was the difficulties of performing the economic analysis, which is, for example, I've got a benchmark range, whether it's cost plus or I've got a profit level I need to meet and be within. But this year I've got significant losses because of COVID. Or by the way, this year I've done really, really well because I'm in a particular industry, which means my sales have increased. And so business was looking for more flexibility. Can I use the top end of the range? Can I use the very bottom end of the range? Can I do a part year comparability analysis? Can I bring in more loss companies into my comparable set? And so that's another area we said, yes, you can do those things, and there should be more flexibility given to business around this. The other point that I would sort of say as well is there was a lot of questions as to, can I refer to the advice in the economic ranges that were developed in 2007, 2008, 2009 as part of the global financial crisis back 10, 15, 14 years ago? And the answer to that was, no, you can't, because that's a different type of crisis and maybe more localized, specific to industries, whereas this is everything. The third point, Jack, was around losses. What do I do with losses and who should bear the losses? What if I have a limited risk entity such as a contract manufacturer, a cost plus service provider, a limited risk distributor? Do I have to provide a guaranteed return like I usually do, or because it's COVID, I can share that risk with those entities? And the answer again might be, well, it depends how you made decisions, but if those decisions were actually made locally and decided locally, then you might be able to, because more risk was taken locally. But if decisions were made around COVID in a central entity somewhere else, then you'll need to actually continue to provide a guaranteed return. And the other question around the losses was around, hey, I've incurred lots of losses, guys, because I'm closing plants, I'm furloughing people, I'm getting rid of plant, machinery, I'm restructuring to cope with COVID. Who should bear that? And the answer is obviously refer to the guidelines. It's the person that it's the entity which makes the decision. And lastly, from me on this particular point, the other area we had a lot of questions on was, I've got an agreement with the government around my transfer pricing position, which is often referred to as an advanced pricing agreement. Say that I have some assumptions in that which say I need to make a certain profit level, I have unrealized gains, I've got different foreign exchange risks, which mean that I breach my critical assumptions, which means my agreement dissolves. And the response to that was, shouldn't we have more flexibility to allow governments and business to continue if they want to and if they can agree to with early negotiation and early recognition that there have been some breaches. And that's one of the points which comes out, Jack, which is in relation to there should be more flexibility to not just immediately dissolve it and renegotiate, but perhaps agree to continue. So in summary, on this particular point, I would sort of say those were the 4 key areas. And the theme of that is there should be flexibility with the way we deal with losses, flexibility the way we deal with our ranges, and our agreements with government. So I would encourage people on the call and the listeners to look at the guidance, because it will impact the way that companies need to think about their transfer pricing for 2020, for 21, 22 potentially as well. And one last point from me, just to be clear, this does not change the actual transfer pricing guidelines, but it's in addition to and how to interpret the guidelines for the COVID-19 economic circumstances. Jack.
Yeah. Okay. Thanks for that, Matt. So I think as a takeaway point, I think for those attending from across the region this morning is from a transfer pricing perspective, and we may come back on transfer pricing a bit later. I think it's important that you have a look at and familiarize yourself with the guidance issued by the OECD regarding COVID-19 that was issued in 2020, COVID-19 and transfer pricing. And just sticking with the COVID situation, as we're not out of it yet, maybe Rachel, from your perspective in the region, what are you seeing in terms of key international tax issues and trends in Asia Pacific?
Thanks, Jack, and my thanks to DFDL for organizing this and having me here today. I think you can see really 4 main trends. 1.5 years after the pandemic, we're still seeing a lot of domestic support being given in terms of monetary boost and fiscal support. We do see attempts by some countries to pull out by increasing and stabilizing FDI via incentives and new regimes. Key of concern for most of these countries right now is actually narrowing the fiscal gap. You will see that there's a huge deficit that is being built out from all the support that has been given out to the economies and especially to help the taxpayers. And very little really in terms of digital taxation at this point in time. Now, part of that reason is because a lot of it happened pre-COVID. And with COVID now, with this increased move into digitalization, you find countries sort of holding back on taxing this new growing economy. So from now on, you can sort of see the K split, in the economy, the recovery that people have been talking about, the K-shaped recovery. There are a couple of countries where you can see them pulling away from the mass median and a lot of countries left behind. Across the board, we see a lot of countries continuing to give delays on filing administrative procedures, some income tax rate reductions, usually targeted domestically at the SMEs, and a lot of incentives and boosts for certain industries. Now, I'll do a country by country coverage for some of the key countries, and you can see how the groupings are going to form from there. I hope Matt will forgive me for starting off with Australia instead of New Zealand, but I wanted to get it out of the way because there's not really much happening in Australia. And I mean that in terms of tax measures, nothing else. But, it's been a fairly stable economy over the past years. They've managed to control the COVID infections to an extent, and that is seen in the tax measures that they're coming up with. They've got very targeted measures that are focused on the domestic economy, with very little broad measures happening outside. I think the most significant measure that they've implemented is that they're one of the few countries, if not the only country, that has allowed work from home expenses as a direct deduction against your employment income, and they've absorbed that into their system. Most of the other countries instead have preferred to give you exemptions if you get additional work from home allowances, but Australia allowed you to take it off directly for employment income. Now, when you talk about Australia, you have to move on to New Zealand, and this is where the focus will come in. When you talk about stability, New Zealand obviously is ahead of everyone else. They've managed to control their rate of infection, And it's again reflected in the kind of tax measures that they've adopted. You know, really targeted, boosting on small companies and small businesses. Nothing really grand or extreme going on, except that it's one of the two countries that actually had an increase in tax rates. So it had an income tax top rate for individuals coming in at 39%, right? So at a time when maybe countries who are still struggling may be reducing their tax rates, we see New Zealand just putting in this top rate at the end of the year. And that to me is indicative of an economy that is slowly coming out of this pandemic. The only other country that has done that has been South Korea. Now, South Korea, though, they implemented this new top rate in the middle of June last year. Probably a little bit premature because shortly thereafter they had a huge new wave of infections coming in. And they stand out from the rest of the other countries in the region who have preferred to sort of maintain the status quo, looking to drum up the economy instead via targeted incentives. And the kind of incentives that are being implemented out there or shown out or proposed out there shows you the focus of these economies. So Malaysia has put out incentives when it comes to its manufacturing sector because we are quite heavy with the manufacturing, and for tourism. Right, because that's also one of our key income generators. For China, there have been quite a few incentives, but the key ones are on the film industry. It's a booming film industry in China, and with this COVID, it's affected that industry and its filming. It sees itself as a rival to Korea's film industry as well, and it's churning out lots of series and movies, so they've needed to boost that and increase investment there. If you look at Indonesia and Philippines, now they've come up with more job creation measures whereby they want to reduce the unemployment rate locally, giving exemptions for new jobs created, for new investments coming in. It's a matter of trying to increase FDI. Singapore and India, two of the other big economies, have decided to not really increase their the general tax rates. Focusing instead on incentives for the financial sector and also on the aviation industry for Singapore, which is taking a very sort of cautious approach. We know that they have got their numbers under control, but Singapore, being so heavily reliant on the global economy, can't afford to go too fast and too extreme out there. So they are trying at the same time to bolster their domestic economy and industry, but open it up a little bit by bit. And you see that in the other measures that we'll talk about later when it comes to Singapore. India is pushing on the startups that we can see. They've also been a bit more aggressive with their levies. We see that with the indirect tax wave. Indirect tax is another way that countries are looking to widen their tax base. And it makes sense in the time of a pandemic to link your tax revenue to consumption, because those who haven't been as badly affected would be able to spend more. So you'll see that with Singapore now introducing GST on low value goods, on non-digital services. They have deferred their GST rate hike for another couple of years, being very vague, if you want, being very coy, saying sometime between 22 and 25. And then in Indonesia, you see a switch from GST from brick and mortar services to more e-platforms. So they've extended their VAT to apply to e-platforms, considering them as delivery partners. So they've put that in and appointed, the usual Facebook, Amazon, Shopee as collectors. So when it comes to like the digital economy, we see sort of a twofold approach. There are countries who are giving incentives and regimes for companies that are starting up, who are digitizing, accelerated capital allowances, working in collaboration with existing platform providers to sort of move them on to a digital sort of business model. So that's one fold. Then we see that when it comes to taxing the actual income and the economy itself, it is a bit slow, except when it comes to VAT. And like I said, that's because pre-COVID, there already has been a slew of all these unilateral digital measures. We've had the digital service taxes, we've had the Google taxes, Netflix taxes, and now we move on to the YouTube tax, which has just come out of the US. Now the YouTube tax, this is really interesting in terms of policy implications. The YouTube tax, for those who may not be aware of it, has always been there. YouTubers in the US have always been taxed on their income. What they are doing now is that they are taxing YouTubers who are based outside of the US, and they're doing that via withholding tax on their income. So if you are based outside of the US, if you have a significant US viewership base, then you will be subject to a withholding tax of 0 to 30%, depending on whether or not you have a tax treaty with the US. Now, if you have a tax treaty with the US, you would be entitled to a lower tax rate. If not, the flat rate of, I think, 30% applies. And the things that you have to bear in mind here are that you're based outside of the US, but you have a large US viewership. And this is interesting for 2 points, which is the exchange of information on this is a goldmine. I mean, that kind of information that is coming in from YouTubers around the world who now have to file or provide that information to the US for them to be taxed appropriately. So that's a lot of exchange going on there. I mean, that's really something to look into. And the other interesting thing is that the US considers viewership as a source for direct taxation. Now, viewership, by right, is consumption. So you have a consumption-based source for a direct tax. And that I find really interesting. And the implications of that, well, we've not felt it yet, but imagine if that was to go across globally, and you'd have all this information now of a country to all your YouTubers. You know where their viewership base is, you know how large it is. And if you follow suit, you could actually have that source in your country and by right tax them based on that. So it's a huge thing that's actually out there. So, you know, I think if you thought that you should be filing your tax information with the US, you might want to think a little bit again, especially if you don't have a tax treaty with that country. You're no worse off, but that's something to really look into. So there you can see really that new innovative ways in taxing sort of digital revenue beyond what was put up pre-COVID. And that, you know, as a recap, we're looking at also countries at the same time trying to build digital economies amongst their local domestic economy by giving the incentives and not really going that hard after them as well. And one of the key problems with that is that we have a lot of unicorns. So you have your Grabs, your Gojets, your Fruit Pandas, you know, and while they may have the increased activity, they may not actually be getting increased profits. And that's a big issue for local governments. So they've got all this activity and business and maybe revenue coming in, but not necessarily profit making at this point in time. Yet in this COVID times, really essential. And you have, and just to recap what I said earlier, you've got the stronger countries like Australia and New Zealand kind of pulling away in this K-shaped sort of recovery, where they're able now to tax greater income. And the more middle of the line, I would say countries like us in ASEAN, whereby we're still trying to boost our domestic industry, keep our FDI kind of stable, and help up those odd industries that we really, rely on.
Thank you for that, Rachel. That was a fantastic oversight of YouTube tax. I think it's it's testing the boundaries as to how far this could potentially go. We could be a few years down the line with our TikTok tax and our you know, and if
yeah. Instagram's the next to follow, you know, I mean, you got to say that's going to be it. They're all in the Google any which way, so you know, they're at least on Facebook. The Gram will be the next to go, and maybe TikTok will definitely follow. So it's very interesting how far this is going to go.
Wow. Okay. Thank you, Rachel, for those insights. So so we're going to move on a little bit. So you know, we're going to discuss a little bit around BEPS now, and you know, we're still dealing with, before we move to BEPS 2, which is the Pillar 1 and 2. We still have BEPS 1, which was the massive project undertaken by the OECD globally, and in Asia Pacific, we particularly see a lot of the countries have signed up for the minimum standards in the inclusive framework, and it has major implications for international tax structures, holding companies, financing companies, IP companies, etc. in Asia Pacific. So our colleague Barbara, the multilateral instrument and the principal purpose test. So what is it? Can you give us a short overview of for our attendees this morning?
Yeah, sure. Thanks, Jack. And I'm a bit jealous of Rachel, who can talk about like trending YouTubers and influencers, and I'm down to like the multilateral instrument and principal purpose test. But nevertheless, before taking a deep dive into principal purpose test, maybe we take one step back and see what is actually the MLI. And it was on June 2017 that 68 countries signed the MLI, which is a multilateral treaty, which is one treaty between a large number of parties. And that treaty modified the application of existing bilateral tax treaties. The MLI aims to relatively rapidly include the BEPS measures. I'm sure you've heard all about that over the last couple of years in existing bilateral tax treaties in a consistent manner. So, well, now I'll take you to what is actually the principal purpose test. I mean, we tax lawyers always love to abbreviate everything. So when we're talking about the MLI and the PPT, we're actually talking about the multilateral instrument and the principal purpose test. But what is actually the principal purpose test? It is a BEPS minimum standards that countries must include in one of the following in their tax treaties. It is actually the default options. But there's a couple of more. So we have the principle. There's three options in this minimum standard. There's the principal purpose test, there's the principal purpose test, and simplified limitation on benefits provision, or the detailed limitation on benefits supplemented by anti-conduit arrangements. But for purposes of this sessions, I mean, we can fill a day program, even more probably, on just talking about this specific topic. Let's just focus on the principal purpose test as such. So what does it do? The principal purpose test is denies specific treaty benefits if obtaining that benefit was one of the principal purposes of the arrangement of transaction, unless granting that benefit would be in accordance with the object and purpose of the relevant treaty provision. So how to sort of define that and look at that? What it says is, if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purpose of any arrangement of transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provisions in the treaty. So what does that lead to? I mean, there should be a reasonable conclusion. Conclusive proof is not necessary, but it's also not to be assumed lightly. Sorry. And I mean, these days you're really worried if you're coughing, because everyone is thinking that you have like some sort of crazy disease on there, but I'm alone, no worries. And the object and purpose is to be established by taxpayers, by the taxpayer. So how to determine whether obtaining the treaty benefit was one of the principal purposes of an arrangement of a transaction. And therefore the OECD gave some guidance. And they've broken it down into 4 different elements, and I'm going to guide you through that 4 different functions, because basically it is the significant people's function, the choice for business location, commercial and economic reasons, and local management. So what is it? Is it what we're looking at if we're talking about significant people's functions? That is exercising or expanding real or active business activities, including intergroup services, providing working capital in the form of equity and loans, or performing substantial economic functions using real assets and assuming real risks, or carrying out business activities with own employees and sufficient financial resources. Choice for business location, what is it? I mean, it is probably all the other soft reasons why you choose a particular jurisdiction. It is like the availability of highly qualified workforce, reliable legal regulatory system, political stability, developing banking sector, to name a few. And when we're talking about commercial or economic reasons, that is mostly economic reasons such as low production cost or setting up a company because of business efficiency reasons. And for local management, you have to think of experienced local management team that assesses, approves and monitors investments, performs treasury functions, maintains books and records, to name a few. That sounds pretty much like substance in a new code, but we'll get to that. If you look at the Asia Pacific region, you would there's a couple of countries that have already signed the MLI, even ratified the MLI, and there are some who are in the in-between space. But if you look at the region, it is Singapore, Malaysia, Indonesia, Australia, India, Japan, and Korea that have all not only signed the MLI, but also ratified the MLI. And there's 2 bit of outliers in there, and that is China and Hong Kong, who have signed but not ratified. And then there's Thailand, that we just discussed earlier today, Jack, is that they have indicated that they have the intention to sign, but they have never actually signed. So what is so interesting, if you look at, I mean, this list, that some of the other countries like Philippines, Vietnam, Cambodia, Laos, Myanmar, I mean, where you would expect that the adopting of a principal purpose test would be largely beneficial, have not yet signed the MLI. And that is not actually a standalone trend for Asia Pacific. That is what we see in other parts of the world as well. That developing countries have not massively embarked this journey of the MLI, and largely it is seen that there's a bit of a wait and see approach, and for all the good reasons, I suppose, also to select and review options selected by other countries, and also use that in between time to build capacity for implementation. So how will that affect your structures? Normally I'll have a large set of structure charts, but I'll try to guide you through maybe one. So typically what you need to do is what we say is check, check, check. So if you have international structure in place, it is key that you continue to check what is there, is the MLI signed by the 2 treaty partners? is it a covered agreement, which means that both countries have signed and ratified, and that it therefore is in effect? And then you need to have a closer look at what is the provisions that will actually be affected. And then the second thing is it's all about substance. I was just mentioning that because, I mean, we've been talking about substance for the last zillion years, I suppose, but with the PPT, if that one is actually in place, it is not so much the level of substance that is important, but it's more so the kind of substance as well, other factors. And the thing that is easily forgotten, that you eventually as a taxpayer need to substantiate what was like your principal purpose. So it's not only of having the right level of substance, but also to have it properly documented. So I think that is in a nutshell what the PPT and is entailing in the region. I'm sure there's going to be a large amount of questions on this one, but I'm also very mindful of the time. But I think the two main key takeaways are, I mean, you need to constantly monitor if the tax treaty is affected, yes or no, and then make sure that you have that documentation properly in place. What you probably will see, I mean, because it's largely a source country issue, that what you probably will see going forward is that source countries may challenge structures going forward and may say that the principal purpose test was not met. So what does that mean? So that would mean that you would need to file objection and probably go to court in that jurisdiction. Since it's less integrated in an Asian context than where I'm originally from, in a European context, you probably see that there's going to be a lot of different court cases in the different jurisdictions. I mean, in a European context, we see that, I mean, a large part of that ends up at the European Court of Justice. In the Asian context, you probably see that there's going to be a large number of case law on this particular topic, and not necessarily is the content and the outcome aligned. So to be continued, I would say.
Okay, thank you, Barbara. Yes, I guess some of the countries in Asia Pacific will take that wait and see approach. I guess as a practitioner in the region, one of the things I kind of worry about is that in dealing with issues of tax treaty benefits and anti-avoidance, has always been, that's been going back since time immemorial, and a lot of, the BEPS initiatives were to sort of deal with this. But we had seen traditionally in the region, certain countries in Asia taking domestic approaches. So they take a domestic law approach towards what they perceive as either tax treaty abuse or as avoidance involving tax treaties. And we've seen this in Vietnam, and we've seen it in China in the previous circular, and we've seen it in Indonesia, where they, for example, they will apply a domestic law meaning, and they'll apply Article 3.2 of the treaty to take a domestic law meaning of the term beneficial ownership, which is not, what the OECD provide in their guidance. So one of the, I guess, as a practitioner, what I kind of worry about is that the principal purpose test extends, it goes beyond the scope of just the dividends, interest and royalty articles, right? It can include capital gains, etc. And is that, it seems that it could almost be, I don't know if I'm using the correct terminology here, but there's almost a subjective nature to it, that certain tax authorities could take an aggressive approach because they could argue that one of the purposes of this structure is to achieve a tax benefit. I guess, one question would be is in terms of the European context, do we have any case law precedent cases that can be referred to in the European context regarding the principal purpose test yet, or is it still relatively new?
Well, you see, I mean, a large number of cases are currently, I mean, in front of the different courts. I mean, still, I mean, the different, not so much at European level yet. I mean, apart from like, I mean, a handful. I think that is going to pan out like in the next couple of months. I would say. It makes sense to look at some of the European case law to give further context and content to like how we should see and read that principal purpose test. But then again, like countries like Indonesia will always be Indonesia, and I mean they'll take their own approach, I guess, and that doesn't necessarily mean that eventually companies wouldn't get, I mean, it wouldn't be awarded, but I mean it could be very troublesome and time consuming.
Yeah. So okay, so I think this is definitely one of the hot areas to watch going forward around international tax structures, and I guess the traditional route of just opening a holding company in Singapore, Hong Kong, and I think that needs to be considered carefully, and as you said, you need to check on all of your structures. Just moving on slightly, so as to that was BEPS discussion 1, and BEPS discussion 2, and what's currently happening at the OECD. I think it would be fair to say that some of the tax policy, the international tax policy that's being discussed, is quite a big move away from the traditional way international tax policy was set. So, Matt, for our attendees this morning, can you give an overview of exactly what's going on at the OECD? What's the policy thinking, and what's the OECD hoping to achieve with Pillar 1 and 2?
Yeah, I mean, I'll probably answer this, Jack, in a series of questions, which is what is really Pillar 1 and Pillar 2, and why do we have it? And I think importantly, Pillar 1 is really the name of reallocating group income from really residence jurisdictions receiving and owning intangible properties, or making direct sales, to market jurisdictions where the company is interacting in, say, country A with a market jurisdiction in country B. So, for example, the reason this has come up, it's come up through Action 1 of the BEPS review in 2015, which says a lot of countries are very concerned about how digital companies can interact with their users and their customers and their population without creating a taxing presence through a permanent establishment. For example, it could be, for example, that Google or Amazon, so the GAFA, Google, Amazon, Facebook, Apple, can all interact with a jurisdiction such as, for example, New Zealand, and make millions of dollars worth of sales without any tax being paid in New Zealand. And that's because there is no permanent establishment or no taxing presence created, because it's a remote relationship. And so what's happened is that countries have gone, you know what? We need to reallocate more income to that market jurisdiction where the users are and where the consumers are. And traditionally, Jack, we've had no ability to do that because transfer pricing has always said, you know what, all the value is in the intangible ownership or economic intangible ownership. It's in the functions, decision making, and in the financial and capital, which can be owned in lower tax jurisdictions in sunny places elsewhere. And businesses and then countries have gone, actually, we think there's value with the relationship with the consumer and the users, and that value deserves to be paid more than it's currently being paid, or paid something because nothing's paid. And so this started as a digital project, and actually to capture remote digital relationships, and is now much broader than that. And the thinking has been is there's more value connected to the users than consumers, as mentioned by Rachel earlier, even in relation to that YouTube tax type scenario. But And so the way that we're thinking about that is maybe a little bit different in terms of we're saying, actually, we still have to connect the current international tax system, which taxes individual entities. So what we refer to as the single entity approach. And that means each company has to do its financials. It has to allocate revenues and costs. It then makes book to tax adjustment to get to taxable income. And then we allocate transfer pricing to allocate income to and from entities to create their final taxable income. And that's the way that each entity is currently taxed. Now what we do, that's what I would refer to as phase one. Phase two, with this new taxing right on top under pillar one, says, okay, now that we've each got each entity with its own taxable income, we now have to do it at a group level. We have to sort of at a group tax level. So it's a separate, a single entity approach. Says at a group level, we're going to now say what's the taxable income of the group, and above a certain threshold of profit, we're going to reallocate some of that back to the market jurisdictions where we're interacting with consumers and users. And so there's a couple of pieces to that, which is, okay, which companies are in scope? And at the moment, from the you would see it's consumer-facing companies and automated digital companies. And I'm not going to get into that, but what it's sort of saying is companies that have a connection to markets, a market nexus, and it's more than a market nexus, which is we can think about it at the moment, which is it's not having a physical presence, but it's something more than that, a relationship with the market. And the way we're thinking about that is, how do you decide what the market nexus is? And we're thinking about it in terms of maybe it's revenue in that market above a certain threshold. So say for example, I think about a Singapore principle, which is connecting remotely and selling remotely, for example, to Australia or New Zealand or Taiwan or Malaysia. We would say, okay, does that Singapore entity make sales into those jurisdictions above a certain revenue threshold? Yes, they do. Then you've got a market nexus. Now we have to allocate a certain amount of the revenue of the profit sitting in Singapore to those jurisdictions. How do we do that? And at the moment we're thinking maybe it's pro rata. We pro rata and say that, for example, Malaysia takes 50% of the amount A of this new profit because it's 50% of sales of the overall group or segment. New Zealand takes 10% because it's 10%. Australia takes 30% because it's 30% of the revenue. And so then you reallocate that income to the market to say, in recognition of the value that those relationships make to the overall group profit. And so that's the thinking behind it. But there are obviously some challenges with that. And some of the challenges are, for example, should we do the allocation on a group basis, or should companies be allowed to segment? And they should be able to segment their businesses, because there might be some very profitable parts of the business and there might be some unprofitable parts of the business. And so you don't want that blending to bring the overall profit down, or they might sort of say, oh, I'm not making any money at all in this particular area, so why am I paying more, allocating more income to another jurisdiction? There's also the issue of, and this is probably the most challenging issue of elimination of double taxation. I have to remember I said that the amount A calculation is at a group level. But the funny thing is we're going to now connect the single entity approach back into the separate legal entity approach through this elimination process, which is now I have to find the entities that are actually going to pay this amount A. So I might have calculated it at a group level, but I've actually got to pay it from specific entities in the group, and that's the plumbing back in between amount A and the current international tax structure. And so then we sort of, and this is obviously quite a contentious area and is debated very heavily by jurisdictions which may have to pay this, which include, for example, places like Ireland, places like Switzerland, places like the US, for example, could be Singapore, etc., who have very profitable entities who might have to reallocate some of their residual profit back into other market jurisdictions because that's where the profits sit. And so the questions that come out are, well, how do I know this is actually a paying entity? And should I just think about this purely quantitatively and say anything above 10% profit, PBT or EBIT, profit before tax or earnings before tax, any entity should pay above that? Or do I actually need to have a connection to transfer pricing concepts and say, well, actually, it should be the entities that own the intellectual property. It should be the entities that have the capital. It should be the entities that make the decisions. And do I need to connect it back to transfer pricing or not? And there's very different views from the members around that. And then how do I actually allocate it? Do I need to just go, these are my 25 paying entities within my group? And it doesn't matter, they don't need any connection to any market, they just have to pay their portion of it. So very formulaic. Or like certain jurisdictions are like, no way, I'm Singapore, I'm not paying Lithuania, I've got nothing to do with them. There's no transactions, there's no IP connection, there's no financing connection, there's no transaction connection. And so that's a big debating point as well. And so those are the things that we're sort of looking at the moment as we sort of build this. The other thing as well, I think, Jack, is tax certainty is very important. And so for countries like, for example, OECD countries, the US, etc., having tax certainty, which is I have to build my amount a Pillar 1 payment on top of the existing income allocation system, permanent establishment transfer pricing, and then I calculate my amount A. But what if 5 years later I have a transfer pricing audit, and so my income changes? Does that mean because my transfer pricing allocation has changed, my amount A has to change? And so many jurisdictions are saying the only way this can really work is if we have tax certainty for the calculation of this new taxing right as well, and that should also extend to the current transfer pricing and income allocation disputes. Now that's quite contentious for a number of reasons, because a number of jurisdictions are saying, well, hang on, I currently unilaterally audit and decide how I want to implement my transfer pricing audits and make decisions around that, and also how I do that from a permanent establishment perspective. But the way this might work, if we're looking for early certainty in multilateral income dispute management, is you would have a panel process where you would have a panel of countries making decisions about transfer pricing and permanent establishment and amount A. And for obviously a lot of jurisdictions, that's quite confronting when you're saying it's mandatory and binding. And so we're looking at innovative ways to deal with that, where there are some challenges from some jurisdictions saying we are a little bit uncomfortable with that. And then lastly, from me, Jack, just in terms of, it is probably worth noting this amount B. It is part of the package for Pillar 1, which is this reallocation of taxing rights to a market jurisdiction. There is also this amount B, which sort of says for all marketed distributors, and it's all marketed distributors, so no scope exclusions, we would have one fixed return globally for those marketed distributors. And the reason this is being thought about is this is an area which clogs up MAP. It creates a lot of domestic resource management issues, because a lot of countries are saying, I've got these marketed distributors that should be making 2%, 5% profit, that are making 3% profit, and I want an easy solution where I can get rid of all these disputes with one overarching approach to this. And again, some of the challenge we're having with that is some countries are saying, well, what's in the scope of this marketed distributor? Does it include a commissionaire? Does it include a buy-sell entity? Does it include a sales agent? So there's a scope issue. The other point is some jurisdictions are saying, well, actually, you know what? I make more in my jurisdiction than those other jurisdictions because I've got location savings. I've got something special about my market. So they're sort of saying, I need to vary and have a higher fixed return because I'm in this region or this jurisdiction where I get more money than others. And then some are sort of saying you also need to vary the number by industry, because pharmaceutical makes more, for example, than consumer products or motor vehicles. And so just in summary, this work is continuing. We're looking to have a political agreement amongst the inclusive framework members, which are 139 countries, by July 21. As you can tell from some of the comments that I've made, there are political areas, and there are technical areas which we continue to work on as we refine the different parts of Pillar 1. And similarly with Pillar 2 as well, which is a minimum tax. I'm not directly involved in that, Jack, but we're on a similar timeline for Pillar 2 around the minimum tax or the globe. And we also are looking at some of the technical issues which need to be resolved so that members can get to that political agreement, such as global versus jurisdictional blending. What are the carve-outs which would be carved out of the minimum tax and the rule order as well. However, I mean, lastly, we continue to work and focus on the political outcome for July 21.
Thanks for that, Matt. It's so just trying to simple question maybe, but it's, you know, tradition transfer pricing, the ALP, the arm's length principle sort of underlying the whole thing, transaction. So where does this, it seems to, is this moving away from the arm's length principle towards a more sort of formula approach, or how does it fit with the ALP?
Yeah, and so I do get asked this question quite a bit. And it would be fair to sort of say, I mean, I'm also head of the transfer pricing unit. So I would sort of say the existing allocation system on an entity level, so the separate legal entity approach, will continue. This is, and in my view, and this is just Matt Andrews speaking, not the OECD, but my particular perspective is that some areas that we're using to allocate the income and the formula used to do that sounds like formulary apportionment, which is a movement away from transfer pricing. And in that group, in that sort of single entity group approach, it probably is. And the reason is, I think, is for political and pragmatic reasons, is it's difficult to overlay separate legal entity transfer pricing rules on a global group basis. And so I would sort of say we are stuck with the transfer pricing rules for the foreseeable future, but we're using this in terms of pragmatism and as an approach to get sort of obviously to a political agreement between 139 countries.
Okay, Matt, one of my colleagues has messaged me to ask, how does this get legislated? Is it going to be, is it part of the transfer pricing guidelines, or will it be a separate, you know, how will this be legislated?
Yeah, and so it's a good question. So at the moment, we're looking at different options, but my sense would be the debates that we've been having, and you would have heard these in the public consultation process in January, is it's very likely that we'll look to a multilateral convention, and we'll have the multilateral convention which sort of sets out the rules for the different elements. But beside that, we'll obviously have for each of the elements what I would call the commentary, which would not be dissimilar to the transfer pricing guidelines, with examples and how each of those elements work. Nexus, for example, scope, tax segmentation, elimination, profit allocation, etc., which would be the sort of the guidance for both administrations but also businesses on actually how to implement this. It would also be fair to say we are looking at some domestic rules, domestic law requirements as well. And I think there are certain jurisdictions which you can probably guess would prefer to have domestic law as opposed to signing a multilateral convention. So we are looking at various ways. But my sense, Jack, is this, from a consistency of approach and implementation, a multilateral convention is something we're looking very closely at.
Okay, thanks for that, Matt. We're running a little bit late on time, so I'll take just one or two questions. A question on the YouTube tax. Rachel, is the YouTube tax a US response to unilateral digital taxes?
I don't know. I think that's a short answer. It's hard to say where where IRS is coming from, but I think you have to bear in mind that YouTubers in the US are already being taxed any which way. So this isn't new to YouTubers. It's just they've probably realized that how they were going to try and apportion that income and looking at the way that they were going to tax that income. And if they were basing it on US viewership, then it would only make sense to them to extend it to YouTubers based outside of the US. Is it a response? Well, I wouldn't say it's a direct response, but you must bear in mind that all countries are trying to increase their revenue from the digital economy. So this is one way that they're going to do it. And if it flies, I mean, with the US, like we said earlier, there's still Instagram, TikTok, Facebook Watch, all these other social media platforms that you could actually be a potential gold mine out there.
And Barbara, one of my colleagues has asked, in connection with the MLI, the multilateral instruments, how do they check which countries are in, which are out, and when is the effective dates?
Well, that comes back to you, right? So the OECD has, like, I mean, a massive portal, but you need to be quite sophisticated to navigate the system. Are you hearing that, Rachel?
I can answer this. The IBFD has a monitor. We do have a monitor. Unfortunately, it's not free. But if you subscribe to the IBFD, we do have a monitor that keeps track of who has signed up, who hasn't signed up, when the effective dates come in, which of the exceptions are, in sync, which of the clauses, which of them are not, which there's a matching thing. So we do have that information. I'm not quite sure if the OECD has their own, but the IBFD does.
Yeah, they have, but the thing is, I mean, you need to know quite a bit from, how it works and how it depends to find out, when you're talking about a covered arrangement, and when particular provisions are affected. It's not easy to read. But I'm pretty sure that in due course of there will be new bundles coming out with like a treaty plus MLI implications, so that it's easier to navigate. But I know some old professor who's working on that.
Okay. And Matt, we have a question from Voskamp. Is there any indication on the actual global minimum tax rate and the timetable for the agreement and the actual implementation dates?
Still, so in terms of the political agreement, it would be the same time. So the two pillars are connected in terms of July 21. No, I can't comment on the rate because it's being negotiated. And in terms of timing around that, I guess it's still to be debated at the inclusive framework. But we do hear things such as 23, 24, for example, as being dates in terms of actual implementation.
And Matt, just in terms of the guidance on the transfer pricing in COVID-19, is that available on the OECD website?
Yes, it is, and so it was publicly released before Christmas. I can't remember exactly when it was, but it was like the 19th or 20th. And so that's a publicly available document, which is, if you go to the website, you'll be able to get it.
Okay. Okay, we're at 11:07, so I won't keep this any longer. I want to thank our very special guests this morning, Rachel, Barbara, and Matt. Thank you for your time. And your contact details are on the screen there now. So if anybody has any questions, or they want to contact Barbara, or they want to contact Rachel, or want to contact Matt, please feel free to do so. And I wish everybody a nice afternoon and a nice week ahead. Thank you for your time this morning. Take care.
Thanks very much. Thanks, Jack.
Bye.
Okay. Bye.